This is Funded. When you subscribe, you turn knowledge into money. New Zealand grew up believing in a simple story. Interest rates fall, life gets easier. Mortgages shrink, confidence rises, the country breathes again. But stories age, and this one just broke. Because something strange happened after the latest OCR cuts. Instead of falling, long-term mortgage rates climbed, swap markets surged, financial conditions tightened, and suddenly the Reserve Bank, the banks, and the market no longer were reading from the same script. You can feel the nation holding its breath. If the OCR is losing its power, then the old rules are gone. We're joined by Westpac Chief Economist Kelly Eckholt. Kelly, why did mortgage rates rise even as the OCR was cut, and what broke the transmission mechanism?
Well, the Reserve Bank's rate cut was well anticipated, but what wasn't anticipated was that the Reserve Bank called time formally on the easing cycle. Running into that monetary policy statement, financial markets thought there was a chance that there might have been a further interest rate cut coming, perhaps early next year or perhaps towards the middle of next year. But the Reserve Bank really poured cold water over that. The governor said, for example, that there was a high hurdle to be breached before you could expect another interest rate cut. So, markets were surprised by this, and they've had to reevaluate what the risk profile is for medium-term interest rates, given that there's no more cuts really in the likelihood. That raises the question of when will rates start rising and how much will they increase by? And that's why we've seen rising medium-term wholesale interest rates, things like the 2-year and the 3-year and the 5-year swap rate, all gone up by 50 or 60 basis points over that period. And that's had the impact on mortgage rates because that's the interest rate that we use to fund ourselves so that we can lend that money for those sort of terms.
Was the Reserve Bank governor over-signalling? Too much communication sometimes is worse than saying less.
Well, I think they did over-egg it a bit. Their projections spoke for themselves in large part. They basically suggested that there wasn't really very much chance of another cut and that a hike might come sometimes in 2027. And I think if they'd probably just left it at that, then perhaps the market reaction would have been a lot less. But their communications continued to emphasize that the rate cutting cycle was over, that they expected the economy would recover. When interest rates rose in the next day or so, the press asked the governor, is the sort of market reaction that you expected? And instead of saying that, well, they thought that they didn't need to see interest rates go up, they said that this is pretty much what they expected. So financial markets took that as a green light to say, we probably should push interest rates up a bit.
Yeah. And we have seen a bit of a cashback war. The banks are really trying to induce clients, new business. Is this reflective of what's going on in the OCR space as well?
Well, we've moved ahead of the other banks. We increased our mortgage rates and none of the other banks, at least to date, as I understand, have done so. But everybody's facing the same pressures. So I think that it's probably reasonable to expect that those interest rates will go up over time. If I look at the margins between the mortgage rate and the 2-year versus the equivalent wholesale swap rate, it actually looks like a pretty skinny margin. Like normally it would average about 2% over. Right now it's sitting more like about 1.6% over. So, and that's on the basis of our higher mortgage rate. So you can understand that there'll be some pressures there, I think, for rates to go up.
And who's going to see the pain the most and first? Is it investors, first-home buyers? Is it these guys that are getting their consent sorted now?
Well, I don't know if we're really talking about pain here. For the most part, these interest rates are still at or perhaps even a little bit below 5%. So that's actually not a very high interest rate. It's not as low as it could have been a couple of weeks or so ago. And, I think there's been a lot of advisors starting to suggest to people in the last few months that now might be the time to go for the longer term fixed rate because the end of the road for rate cuts was approaching. It's arrived now. And for those that perhaps just hung back because they thought that interest rate cuts would just continue ad infinitum, I think they're a bit disappointed. But you can still go out there and get a pretty decent interest rate. So I wouldn't really categorize it as pain.
And what signals should homeowners be looking for other than the OCR? Is it inflation expectations or something more important?
Well, I think the key thing here is what is the economy going to do in terms of growth and when will jobs growth resume? And right now is actually some more encouraging signs. For example, just recently we released our forecast for what we think that GDP growth will have done in the third quarter. And we think that it'll actually have increased by 0.9% for the quarter, which is pretty encouraging because it basically fills in that big hole in GDP that we saw in the middle of the year, in the June quarter. And, it's probably a sign that we are going to see stronger growth ahead. What we haven't yet seen is really strong signs of jobs growth yet. Perhaps a few signs at the margin, job advertisements have picked up. Some of the really high frequency indicators of jobs growth have started to pick up a bit. But it's going to be a while before that occurs. And we have to remember that the Reserve Bank will want to see the economy growing at a decent clip for a reasonable while before they really start getting around to putting up interest rates. I mean, my sense is the financial markets have overshot here. And actually, eventually, they'll recognise that it probably isn't going to be a mid-2026 tightening beginning, but it might be something a bit later on. I mean, my forecast is that it happens in December, for example. I mean, I think that's still the forecast now. And, sometimes markets basically overreact and overshoot, and that's what we've got now.
And Westpac's still projecting strong house price growth over the next 4 to 5 years?
We're expecting better house price growth than we saw for this year. So house prices continue to be flat in nominal terms. We're expecting that in 2026, we'll see 5.4%. And that's a reflection of the fact that the interest rates have fallen. We think, for example, that we're still only 60% of the way through of the pass-through of all of the rate cuts that have occurred to date. Still a lot of people to roll on to lower mortgage rates. As we go through the next 6 months, quite a lot of activity even occurring now. So more money is going into people's back pockets. And we think that some of that will find its way into the housing market and cause modest house price growth.
And what are the early indicators for consumer confidence? The retail spending and business spending is picking back up?
And many of these things are starting to look a bit better now. Retail spending, for example, we looked at our card spending data and that actually increased quite significantly just in the last month or so. And people were actually spending more money on the nice to haves as well as the sort of like the basics. So that's a pretty encouraging sign, I think. Business confidence has picked up quite strongly in the last monthly indicator survey that we saw. That was pretty encouraging. And it was more than businesses saying that they think things will be better in the future. They were reporting that things had been better in the last month or so. So that's a very encouraging sign.
On the political side, certainly with Westpac moving first to put rates up based on swap rates, you guys don't control that. What place does the politics have with regards to OCR and RBNZ? There's a lot of jostling for news bites, but can these politicians actually impact interest rates that much?
I don't think so. I mean, the new governor has been very orthodox in that regard by saying it's important that there be independent monetary policy. She's been emphasising that it's important that they remain focused on inflation. Those are exactly the things that you should be focused on. It's another reason why I don't think that these rises in interest rates we've seen for wholesale rates are going to last, because right now the inflation outlook looks, if anything, a bit more comforting than it did a few months ago. We're starting to see quite weak increases in rents, which is an important part of the CPI. And I think food price inflation is going to start coming off quite a bit as well, because we've seen lower commodity prices and things like dairy prices. So, your butter and your cheese your milk, all of that stuff might even start going down a bit as we go through the next few months or so.
And what's it like over the ditch? The RBA has been making similar moves to the RBNZ, and is it a case of New Zealand dollar needing to adjust if changes don't come at that OCR level?
Yeah, so in Australia, it's a bit of a different story. Like the Reserve Bank of Australia has moved away from signalling that they'll cut rates, and they're actually discussing now when they might need to raise rates. And that reflects that the economic data in Australia has generally been a lot stronger than in New Zealand for a while, and their inflation rate has been higher. The last monthly read on annual inflation that we got in Australia was 3.8% for the year, which is miles above where their 2 to 3% target range is. So that's naturally rattled the Reserve Bank of Australia and has them thinking that, well, maybe they don't have this quite right there. What this means, though, for the exchange rate is that New Zealand interest rates are quite a lot lower than in Australia and also in the US for that matter. Now, we're basically looking at a period of rates in the twos, whereas those countries are looking at a period of rates in the threes. And, with the interest rates here just not being very high, it doesn't make the currency very attractive. And I think there's probably a decent risk that the exchange rate reflects that and perhaps weakens a bit as we go through the next period.
Well, fascinating time to be an economist. Appreciate your insights. Thanks, Kelly Echo, Chief Economist, Westpac.
Thank you.
Most people treat their KiwiSaver the way they treat an old photo album. They know it exists, they know it matters, they never bother to open it. And that small act of neglect can cost them more than they realize. If you want clear, simple guidance on choosing the right provider and the right type of fund, you can talk to Wealth HQ without paying a cent. Maybe you like the thrill of crypto. Maybe you want nothing to do with investments that profit from conflict. Maybe you just want a sense of control over where your money goes. Wealth HQ strips the uncertainty out of the process. If you want to understand your options, the link below will take you there.